Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
It's a new trading day. Welcome to Modern Investing Techniques, episode 55 for May 28th, 2026. I'm Patrick, coming to you from Vancouver. Here's your daily market intelligence and today's practice trade. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Rising use inflation and energy costs from Iran tensions could pressure consumer discretionary names, making selective bank dividend plays worth screening in TFSA accounts today. Markets opened mixed this morning. The S&P 500 sits at 7,520 with no change. The NASDAQ Composite is at 26,675, a pawn net tenth of 1%. The TSX Composite is at 34,412, down 0.7%. Hot inflation data at a 3-year high, plus Iran tensions are keeping discretionary names under pressure while banks show resilience. About 15 days ago, we picked ACM on an infrastructure contract win that delivered multi-year visibility, yet still closed down 11.35% when rotation hit. Benchmark comparison data is not available in today's feed, so we'll focus on the absolute levels. Bank earnings releases paired with dividend increases create a repeatable income plus growth screen that works well inside tax-advantaged accounts. Today's results from TD, RBC, and CIBC show profits rising between 25% year over year at RBC and solid beats at the others, with all three lifting payouts. The strategy is to filter TSX listed banks for quarter-over-quarter dividend growth above 5% and payout ratios below 60%, then size positions at 3 to 5% of TFSA capital. This approach historically outperforms in late cycle environments when rates stabilize because the yield provides a buffer while capital returns compound. Use Questrade or Wealthsimple screeners to pull the last 4 quarters of dividend history and cross-check against the most recent earnings release for confirmation. The main risk is sector concentration, so cap total financials exposure at 15% even when the screen lights up green. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Today's practice investment is a weekly hold on Dollar Tree, ticker DLTR. The catalyst is raised full-year profit guidance after first quarter results showed steady demand despite higher costs. Technically, the stock is trading near its 50-day moving average after a 12% pre-market gap. Watch for volume above the 20-day average on any follow-through. The stop loss sits at 8% below entry if inflation data continues to pressure margins. The target is plus 4% to plus 7% over the week if guidance holds and consumer spending data stabilizes. Confidence is medium because the guidance revision is strong, but the setup is single factor with macro uncertainty from energy prices. This setup demonstrates how to read forward guidance revisions as a leading signal rather than chasing price momentum after the fact. Listeners learn to pair an earnings catalyst with a volume filter before committing capital. Yesterday's flash trade was on TSM. We entered at $427.02 at the market open and exited at $422.73 at the close. The position lost 1% or $10.05 on a $1,000 simulated stake. The trade lost 1% while the NASDAQ gained 0.1% over the same day, producing negative 1.10% alpha. The momentum setup looked clean on paper, but lacked the volume surge needed to hold gains once broader rotation began. The new rule is to always require volume confirmation above the 20-day average before entering momentum trades on earnings beats. The CI, ICBC, UBS, S&P China 500 Index, ETF, ticker CHNA.B, is executing a non-cash reinvested distribution on May 29. This automatically consolidates units so holders keep the same share count while the NAV adjusts. The structure lets Canadian investors maintain TFSA contribution room without triggering taxable events or managing cash drag. Use it inside registered accounts when you want China equity exposure without the paperwork of foreign withholding taxes on cash dividends. Kinaxis is hosting 3 days of sessions starting June 1st, focused on AI-driven decision orchestration for supply chains. Attendees will see live demos of how the platform ingests real-time data to adjust inventory and production forecasts. Free virtual access is available for registered users on the company's site. CIBC is selling its 91.67% stake in CIBC Caribbean for $1.6 billion US. The move frees capital for core Canadian and US operations while the bank reports higher second quarter profit. Add CIBC to your TFSA watch list for potential post-deal dividend sustainability review once proceeds are quantified. Royal Bank reported a 25% year-over-year profit increase and lifted its quarterly payout. Compare RBC dividend growth rate against TD and CIB covered the next 2 quarters before rotating within the Big Six basket. U.S. jobless claims rose modestly to 215,000 but remain low overall. Hold CAD cash allocation steady until claims print above 230,000 or the TSX 50-day moving average is reclaimed. Best Buy beat first quarter estimates and raised its second quarter sales outlook on steady gadget demand, plus ads and marketplace growth. Watch for a retest of recent lows before adding consumer discretionary exposure via XLY or similar. Across 25 simulated trades, the portfolio shows a 56% win rate with 14 wins, 10 losses, and 1 break-even. Cumulative profit and loss stands at $104.73. Average return per trade is 0.42%. The best trade gained 13.36%, and the worst lost 11.35%. The current streak is 1 loss. Our AI analysis is learning from volume confirmation failures and adjusting entry filters accordingly. Imagine you bought a consumer discretionary ETF last week when inflation data first printed hotter than expected. Your order filled at the open, but what actually happened was a rapid rotation out of growth names into defensives as the yield curve steepened and PMI readings softened. The mechanism is straightforward. During expansion, cyclicals like industrials and consumer discretionary historically outperform by 4 to 8% annualized. At the peak, staples and utilities take the lead because earnings visibility matters more than revenue growth. Professionals always check the 10-year minus 2-year yield spread and the ISM New Orders Index before reallocating. The biggest mistake with sector rotation is treating it as a timing tool instead of a risk overlay. Instead, always keep a core 60% in broad market ETFs and use only 20 to 30% satellite sleeves that you balance when the yield curve or PMI crosses its 200-day average. Before we wrap, open your brokerage's screener tomorrow and test how the bank dividend filter performs against fresh earnings data. That's your modern investing techniques for today. Every episode makes you a sharper investor. Subscribe, leave a review, and we'll be back tomorrow with more market intelligence. This episode used AI voices synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't last?